The next product is a first to default put. So by definition, this provides a hedge against the first loan which is defaulting in the loan portfolio. So firstly, this is a product which is very popularly used by banks for their products which are sitting on the banking book. So we know that for any bank, we have a classification of its portfolio into what we call as the trading book and what we call as the banking book. So trading book generally has a trading position like maybe a fixed income product or maybe a derivative, an FX, an option, etc. Whereas banking book can have products including loans, overdrafts, etc. So when we talk from a perspective of the first to default put product, that is more popularly used by banks for managing the risk of their loan portfolio or for their loan book. And the idea is if there are n number of loans in which are sitting on the bank's book, then the bank will get compensated for the very first loan which defaults on that particular loan portfolio. So that's why the name is called as first to default put. So whenever the first loan on the entire loan portfolio defaults, the bank is going to receive one payout. And for the exam, remember that the bank will receive a compensation or the payout only for the first loan defaulting, not for any subsequent loans. Now, there can be a question that why not insure the entire loan portfolio? So yes, it's a very valid question. A bank will definitely like to manage the risk of their entire loan portfolio or the loan position. However, the cost which will be there for hedging the entire loan book is going to be very expensive. So not every bank will be willing to take that, because by expending that much amount of money for purchasing protection against the default of the entire loan portfolio, bank is going to end up paying a lot of premium payments on these derivatives, and that is going to start eating into the overall profitability. So from the rationale of managing costs, what a bank will do is it will purchase a first to default loan because it is always cheaper to do that. Now, this is where a concept of correlation also comes into play, because when we talk of a bank's portfolio, the bank will try to, a loan portfolio specifically, a bank will try to always combine loans whereby the correlation between loans is low. So, correlation is an important factor, something which we depict by rho commonly in statistics or financial analytics. So rho or the correlation factor will, whenever that is low, that protects the banks from any kind of defaults which will happen together on a set of loans. So let's say there are 10 loans on the bank's books, but if the correlation across these loans is very, very low, then that is considered as advantageous for the bank. Because if the correlation is low, that implies that if the first loan is defaulting, then the probability of second loan defaulting is lower because the correlation between those is low. Contrast this with a scenario whereby the correlation is high. Now that is considered as a risky proposition because that may lead to multiple loans defaulting at once, which can make it difficult for the bank to manage its credit risk. So whenever you look from a bank's perspective, bank will always try to diversify the risk on the loan book as well through the factor of correlation. Now coming back to our discussion on a few additional features pertaining to the first to default put. So just like CDS, let's try to understand it via a simple pictorial representation. We have a protection buyer and a protection seller. Let's say the protection buyer is a bank and a protection seller is a dealer in the market. Now the bank is having a loan portfolio. Let's say there are four loans which are there on the portfolio. These are having say a certain par value of 100 as and the TIBOR plus 100 basis points, the payout and the time to expiry is 5 years. So this is my so imagine this is my banking book. Now, as a part of this derivative, so focus on the upper section of this diagram. So this will be your credit derivative transaction. So in this, the protection buyer, which is the bank, is going to make a specific payment to protection seller. So it will be a certain basis points into the notional on the multiple loan amounts which are sitting on the books. And whenever there is a first default which happens on these loans, then the par amount will be paid by the seller to the buyer. That is from the dealer to the bank. Now, now let's try to understand a few more nitty-gritties pertaining to the first to default put. Now, assuming that the defaults are uncorrelated. then the dealer or or the counterparty who is selling this product, they need to compensate the bank with a value equal to par value into the probability of default, or PD as we call it. Now let's assume that the probability of default for each of the loans in this four loan book is 1%. Then the probability of the default of entire loan portfolio will come out to be 8 million, which is 1% into four loans into 200 million each. Assuming that it's and the face value is 200 million. So we have $8 million, which will be a payout which happens. As I mentioned earlier, banks will always try to diversify their loan base as much as possible in order to take advantage of the low correlation. Because lower the correlation, the chances of multiple loans defaulting comes down. Now, talking from a yield perspective on the first to default put, now this will be a function of two components. One is number of loans in the portfolio. So here we have a factor of 4. So if the number of loans increase, this factor will change as well. And the expected correlation. So naturally, if the correlation is higher, that is going to make the overall loan portfolio riskier. So correlation also plays an important role in what would be the exact yield which will be expected on the first to default put. Also talking a bit on the actual credit spreads on this product. So the credit spreads will be bounded by two levels. So it will be a spread on the loan with the worst credit and the sum of the spreads on all loans in the book. Because not every loan in the bank book will have the exact same rating. So when we talk of spread, always try to relate that with the ratings perspective or credit ratings perspective. Because when we talk of spreads, what we try to imply is we are speaking about the credit spreads which are related to credit ratings. And not every loan in the banking book will be having the exact same rating. That is, they will not have an exact same spread which is related to that. So that is what we call the spread on the loan with worse credit. So that way, there may be a certain loan which is considered more riskier than others. So it will have a spread which is higher than others. So our lower bound will be the spread on the loan with the worst credit, and the upper bound will be the sum of spreads of all the loans which are sitting on the bank's book. Now, trying to relate this from a correlation perspective. So if the correlation between the loans in the banking book are low, then the actual credit spread will be closer to the sum of the spreads on all the loans in the book. Whereas, if the correlation is high, then that will mean that the spread will be much closer to the spread on the loan with the worst credit.